Hello, everyone. Hello, and welcome to this afternoon webinar. How are you guys doing today? I see more and more people joining us, and this is fantastic. For those you who don't know me yet, allow me to introduce myself. My name is Theo. I work here with Admirals, and I'm here to introduce you Paul, who is going to take over this webinar. Just before we start, guys, please make sure, if you haven't yet, subscribe to our YouTube channel here at Admirals. I will send you on the chat the links here for YouTube, Instagram, and Twitter. In regards to the YouTube channel, please make sure you go and watch a few videos. Hello, Paul. And for the upcoming live streams, I present Mondays, Wednesdays, and Fridays. You can subscribe here, and you can go to the spotlight and see all Paul's recording webinars, because all of them are connected, the one with each other. And please go to the Instagram page and find, as I send you, instagram.com Admirals Global, and subscribe here so you get all the updates about what's going on in the markets in terms of shares, currencies, and so forth. And also on Admirals Telegram, because we post whenever we're going to go live. It's you're going to receive notifications and also all the updates about the markets events. How are you doing, Paul?
All the better for seeing you, Theo.
All right. So, guys, I will leave you safe in one of the most experienced and expert traders, Paul Wallace. The microphone and the screen is yours.
Excellent. Thank you, Theo. Thank you for the introduction. Hello, everybody. I hope that you can hear me. Hope that you can see me. Thank you for the introduction, Theo. That was really very good of you. I'll just bring up our slides just to begin today's session. That should hopefully all come through there. So just bear with us a moment. Excellent. Excellent. We'll get there. Okay. Super. Just here we go. Excellent. So I hope you can all hear me. Hope you can all see me. If you can let us know, that'd be very helpful. Great to be here. As I said, thank you for the introduction, Theo. Today we're going to talk about combining price action setups. Theo gave a great introduction there, and basically sort of gave you a list there of some of the fantastic content and items that are available to you here at Admirals. And today we're going to talk about combining price action setups. So really what we're going to be talking about is building upon some of the sessions we've done in the past, where it's all been about price action trading, and we're going to be doing more of that in the future. But today what we'll look at is just putting together some different price action setups that can help you as a trader start to understand and develop your skills as a price action trader. So yeah, remember, here we are, Admirals, a Forex and CFD broker with a global presence and local support, licensed and regulated across a wide range of regulatory environments, providing competitive spreads on the most popular trading products and giving you the opportunity to engage with markets through both the MT4 and MT5 platform. If you have any questions about Admirals, please get in touch with your account representative. As Theo mentioned there, you can also subscribe to Admiral's Telegram channel, which will just give you more timely insight into content, and also as to when we're doing live sessions. You can follow that on Telegrams at Admirals. So what we're going to talk about today, as I said, it's all about combining price action setups. So I'm going to sort of talk to you a little bit about helping you understand the importance of being able to combine price action setups so that you're in a position to build a more comprehensive trading plan for yourself in terms of the way you engage with markets. That'll help you identify better setups in order to increase your trading opportunities. And that's what we're looking to do here, to be able to educate you and provide you with some insight that allows you to sort of go away and engage with markets on your own. Okay. For those who don't know me, my name's Paul. I've traded for many years, all right, traded for funds, traded for clients. Primarily, I like to focus on FX indices and commodities for my own trading. For my longer term trading, I tend to be a trend trader. And for my shorter term trading, I tend to be a reversal or mean reversion trader. So, ladies and gentlemen, let's talk about combining price action setups. It would be interesting to know, those of you who are here with me in the room today, it'd be interesting to know what, if any, experience you have of A, trading price action, and B, being able to combine price action setups yourself. Maybe you see them, maybe you know them, maybe you understand them. If you do, it'd be great just to sort of put in the chat box, just put down your own little thoughts and comments, whether you've found that easy to do, whether you've needed a little bit of help and insight, or whether it's completely new to you. And that's absolutely fine if it's completely new to you. That's what these sessions are for, as a way and a means to basically give you the opportunity to sort of learn and understand and pick up kind of new ideas and concepts. So, as the slide says, in previous webinars, we've covered using price action to build your own trading plan. Price action is it's a very simple, it's a very good way for a place for starters to begin with in terms of their trading journey. And we've shared numerous price action setups that provide simple, clear entry opportunities. Today, we'll go a step further and talk about the power of combining these price action tactics. And we'll look about, well, how can we utilize these tactics to enhance our trading plan? So Nicholas said that he's completely new to trading, excited to learn. That's great. Thank you. Thanks for sort of your feedback there, Nicholas. You're in a great place here, okay? There's, we'll talk about lots of opportunities here, okay? Lots of new ideas and concepts that will help you with your own trading. And as Theo mentioned right at the start, remember there is the Admirals YouTube channel that has, a wide range of content there from myself and my colleagues at Admirals, all providing you, additional educational insight, which can be really useful when you're starting out on your journey, to be able to just watch those videos a few times if you have to, just to basically get the concepts and the ideas really clear in your own mind. But that can actually help you enormously in the way you operate. But as I said, we're going to talk a little bit about the power of combining these price action tactics that we've discussed in the past. What happens when we start to see them occur together? It doesn't happen as often as we would like, all right? It doesn't happen as often as we like, but when it does happen, it can provide us with very clear and very powerful setups. And also, probably what's quite important for the audience we have here today is that they are what I like to think of as time frame and instrument agnostic. Namely, you will see combined price action setups occur across all instruments, across all time frames. So if you're a 5-minute euro dollar trader, or you're a 4-hour sort of gold trader, or maybe you're a weekly trader on the DAX, doesn't really matter. Okay, if you can identify these, they will give you skills and ideas and concepts and tactics that you can utilize across timeframes and instruments. And I think that's always been useful, always been helpful. That's always been my idea, to share that with you, so that regardless of your particular style of trading, you can have ideas and tactics here that can help you in your own particular trading. So with that in mind, let's have a very quick price action trading recap, because there's lots of people here like Nicholas and others who are completely new to trading. So what is price action trading? What is it? How does it differentiate itself from other forms of trading? It's a basic means of market analysis using price movement over time. And it is popular with both retail and institutional traders. And what we're doing is we are analyzing the changes in price over time, the action, all right? We're always looking for what the price action is. Ideally, what we're looking to do is typically focus on price action over the last 3 to 6 months, but also respecting longer term price movements. So, if we're trading, let's say on the daily chart, then, typically focusing on price action over the last 3 to 6 months is what works for us in terms of being able to build a picture Okay, build a picture of what's going on in that market so that we can make good choices about what we look to do. Of course, if we're trading, if we're trading 5-minute charts, then basically looking back over the last 6 months is probably a little bit too much. There, you might be looking back over the last 3 to 6 weeks, or maybe even the last 3 to 6 days, all right, depending upon the intensity at which you trade. But what we're really doing, the important thing is analyzing the differences, okay, and the changes in price over time. And by doing so, we also start to sort of take a little bit of a deeper look into the underlying psychology of what's going in that market, trying to recognize and pick out, where there are opportunities for ourselves as traders to do good business, okay, to operate effectively as a trader in the market. You'll find that there is tons and tons of material on the Admirals website and also on the Admirals YouTube channel. If you want, to really have a look at price action trading in depth, all right, by all means, I would recommend you do that. There's plenty of, absolutely, top drawer, okay, material there that you can utilize to help you with your own trading. But today, as I said, we're going to focus on we'll do a little bit of a recap, but also look at, more importantly, how can we actually combine these, okay, some of these setups together to give ourselves, the best sort of trading opportunities. So, as my host there is saying, you're at the best place with an expert trader educator. Well done for your decision to be on here for Nicholas. Okay, so you're absolutely right, and all of you, you're all very, very welcome, and I do appreciate that. When we're having these sessions, that we have a truly global audience, even though these are the English desk webinars, we have a truly global audience. So from wherever you are in the world joining us, you're very welcome. And also we truly appreciate we have a broad range of experience in room for our sessions. So namely, some people are completely new, some people who are, intermediate and advanced traders. You're all very welcome. There's always something for you to be able to take away and something for able to help you sort of just move forward in your own trading journey. So if we look at our trading recap, how do we start to create a price action trading plan? Well, it's very simple, and you probably, if you've joined my session before, I like to keep it kind of nice and simple for you, is that what we want to do is we want to start with the monthly, the weekly, and the daily charts. And what we want to do is we want to identify price levels that we believe price will react at, which will provide opportunities. Those price levels can be support and resistance. So they can be horizontal lines of support and resistance, which is what, good traders should be doing. Start off at the monthly chart, go down to the weekly chart, down to the daily chart. Draw in your levels of support and resistance, because markets will remember that. Lots of people might say, but Paul, I'm an intraday trader. Why do I care about, the daily levels, okay? But what is important to realize is that there is an increased likelihood of market reacting at those levels. And if you're an intraday trader, you don't want to be buying into resistance. You don't want to be selling into support, because invariably what might happen is, the markets will react at those levels. So even if you're an intraday trader, you want to have those levels on your chart just to give you, an idea of areas where the market is likely to sort of, it's likely to make a decision. It's going to be an inflection point. It might go through it, but it could also reverse off it, all right, which could, ruin your particular trade plan. You also want to understand BRM, big round numbers, especially in things like FX markets, but really for all markets. So, at the moment we've had, pound against US dollar, the 120, okay, 120 big round number has been of relevant use, and interest to us. We had in the euro dollar, okay, a couple of weeks back, we had actual parity for a period there, all right? We want to understand those big round numbers, because once again, even with algos operating in markets, humans, the markets are still a reflection of human psychology, and humans will remember big round numbers and they will look to do business there. So we want to know where they are just so we can be reminded of them. And finally, one of the other things I like to be aware of is aware of my moving averages, because these can become dynamic support resistance. If you think of horizontal levels of support resistance as static, moving averages, okay, are dynamic levels of support resistance. Those of you who've joined me before will know that, I just have a very simple setups when it comes to moving averages. I have a blue 20 period simple moving average, a red 50 period simple moving average, and a green period 200 simple moving average. As I said, moving averages aren't perfect. Okay, people sometimes use them incorrectly. If you want to know more about moving averages, you will find that I've done a few videos that are in the Admirals YouTube collection there that you can actually click on and watch, but they can actually be helpful, as I said, as an area of dynamic support resistance. So it might be an area that business starts to be done. It's an area that price might reverse. That might provide us with opportunity, ladies and gentlemen. So once we've done our setup, okay, in terms of just getting our charts ready, and our charts can be very simple, okay, just simple candlesticks, as I said, drawing in horizontal level support resistance, drawing in big round numbers, understanding, particular moving averages if you use them. But, for many people using price action trading, they don't particularly even use moving averages. They want to keep their charts as clean as possible. And what you might find is through trial and refinement is that, you yourself might say, well, actually, the moving averages help me. You might say, actually, I'm not convinced by them. I'm going to remove them. My own view when it comes to trading and looking at charts is that less is more. I very often find lots of new traders that they've got indicator after indicator after indicator after indicator after indicator. The charts are just covered with indicators. And actually what happens is it just provides analysis paralysis, and the trader is just basically unable to make any decisions because they're overwhelmed, all right, or they're confused by what's going on. So, whenever you're in sort of considering, should I add a new indicator or should I take off a new indicator, take a little bit of a moment to think about that. Generally, I tend to find that less is more, all right? Less is more, and price action trading is about trying to strip it down to basically the simplest elements, namely price over time, and utilize that to make trading decisions. But once we have done that, well, we want to look for some triggers. We want to look for a couple of particular simple candlesticks that would actually help us, give us triggers that would allow us an opportunity to get on board the market. So there are some simple triggers that we have covered in the past in our sessions, and we'll do a very quick recap on a couple of them. Inside bars, out bars, or engulfing candles, the same name, pin bars, and also key day reversals, key reversal bars, all right? This is what we will talk about. So it's about, we've covered them in particular, but what happens is when we start to combine them, when we start to see them happen together, that is when it becomes interesting and useful for us, ladies and gentlemen. That is when we start to take on board that, that provides us a more powerful opportunity. So if we remember the inside bar candlestick pattern, well, as the name implies, ladies and gentlemen, an inside bar is formed when the high and the low of that particular bar or candle is fully formed within the range of the preceding bar. That's what's important, okay? And it's an inside bar, and it's a little bit of common sense, really. Basically the high and low of it is within the preceding bar. Sometimes you will find that preceding bar is referred to as a mother bar or a kangaroo bar. What I want you to think of it is that I want you to think of the underlying psychology, which is basically, think of it like an organism, all right? Like yourself, like humans, okay? In terms of humans breathing, what we tend to do is we tend to surge, then we rest, then we surge. That's what we all do as humans, okay? That's what most organisms will do. Think about the inside bar is the rest. We might have had a surge, now we have a rest, and what we're waiting to see is there another surge, okay? Surge, rest, surge. Just think of it like that. And the market is just breathing like that, like an organism. And identifying inside bars is the rest before the next surge, and we want to be able to position ourselves. And as it says there on the side, as traders, we are looking to catch the next surge. That's what we're actually looking for. That's what we're aiming for. That's where we want to operate. That basically then, is what we're looking at. So there's just a few examples here of inside bars, and and as I said, most of it is kind of pretty self-explanatory, okay? But the important thing is here, I just want you to be aware of that is not an inside bar, okay? That's not an inside bar. Some people might try and call it because the body, okay, the body of the candle is inside, but it has to be the entire candle, okay? The high and the low, and as you can see there, the kind of high of that, the high wick of that is punctured above the high of the candle before. That is not an inside bar. The inside bar has to be within the range, okay? The high and the low of it has to be within the range of the preceding bar. That is what is important to us. So that was the inside bar. Let's talk about the outside bar, okay? The outside bar or the engulfing candle. You know, you might find me using the kind of terms, interchangeably. And, it's the exact opposite of an inside bar. An outside bar is formed when the high and the low of the bar fully engulf, okay? The high and the low fully engulf the range of the preceding bar, okay? The range of the bar before it. That is what we're looking for, okay? It has to be bosh, the whole thing. It must include the complete engulfment of the entire range of the previous bar, not just the body. Once again, some people will just basically work on the body of the candle, but actually, no, what it has to be is it has to be the high and the low. These happen infrequently, okay? The engulfing candles, they happen much less frequently than, say, things like, pin bars, but they are a strong signal when they do occur, and they provide traders with a clue of the next possible move, which is what we're particularly interested in looking for, isn't it? That's what we're kind of curious about. So as I said, they don't happen as often as others, but when they do, they can be very, very, useful trade triggers, especially when we start to see them happening at those levels we've drawn in. So maybe we've seen it happen at, a horizontal support and resistance line, or perhaps maybe at a big round number, or perhaps at a moving average, which is dynamic support and resistance. When we see these things happen, that starts to become very, very interesting, very, very useful for us. So, here we have is, these are good examples, okay, of outside bars. And personally, what I like to see myself is that I like to see that they have a big, strong body, okay, a big, strong body, not just, let's say, a small body and a big wick, although that is, accurate. What I like to see is actually, a real big, strong body. Because if you remember, kind of a big, strong body is a sign that, in particular, let's say in this case, is that, we've had a very strong bearish close, okay? It's just telling me that in that particular case, the bears have taken control, and that's what we want. All right, we want to very clear, okay, very clear to us who is in control of that market, because that gives us an indication of where the next likely direction is for the next session or two. That can be enormously helpful information for us. So we've done inside bars, we've done outside bars, engulfing candles, and then we have pin bars. A pin bar is, as the title says, or as the slide says, it's a very popular trading trigger, very popular indeed. You will often find it called quite a few different things. You might hear it called as a pin bar, or maybe a high test or low test bar, a rejection candle, or a hammer or a shooting star. I am not too pernickety. I'm not too worried how you label it. What I am, worried about is, you recognizing good pin bars. That's the important thing. And as it says there, a good pin bar should have the open and the close within the range of the previous bar. The candle wick should be 2 to 3 times the length of the body. Should also have long nose protruding out from all of the others. And good pin bars, they stick out and they are very, very obvious. All right, that's what we're looking for. That's the important thing. Whether you call it, a rejection candle, a pin bar, hammer, shooting star, I'm not too fussy about, okay, so long as you can understand exactly what it is, because it's understanding what has actually gone and what's the psychology happened within that market to give us the indication of why it is printed that particular candlestick pattern. So, there's quite a few examples here. These are all bullish pin bars, so we would be expecting price to drop before it hit here and reversed, okay, bullish. And these are bearish pin bars. We'd be expecting price to come up before it gets rejected down, okay, before it gets rejected down. Remember, what I like to see is just a small body with a big wick. Okay, generally like to see, just as I say, the good pin bars will stick out from the from the charts. Okay, one of the things you have to just remember with pin bars, and actually candlestick patterns in particular, is that they are reversal patterns in themselves. Okay, generally they tend to be reversal patterns in themselves. So you need to have something to reverse. All candlestick patterns, let's say they lose their power when you're in a consolidating or range bound market. As a general rule, pin bars, they are pin bars and other candlesticks, they are reversal patterns. We need a trend to reverse. Now that trend, maybe it's weeks long, maybe it's actually only 3-4 bars long, okay, but it's enough to give you an indication that we had a move in one direction and it's about to get reversed and pushed in another direction. So there we go, ladies and gentlemen, right? We've covered lots of price action trading tactics in previous webinars, and there are particular webinars within the Admirals YouTube channel that cover each of those individual setups, each of those individual for pin bars, okay, for engulfing candles, for inside bars. So be sure, okay, to check out the Admirals YouTube channel and be able to find them there. However, what we're going to look at today is we're going to become even more powerful when we find that they are combined. All right, when they're more, when there's actually a few of them together, we find them, that become even more powerful. So what does that actually mean? Well, that means when you see a combination of inside bars, pin bars, engulfing candles, and key reversals, well, then together we have some really very strong setups. Those strong setups that can be actually very, very useful for us. So in particular here, just even on this chart here, is that in this particular case, you have, there's a pin bar, followed by an inside bar, followed by another rejection candle before price makes a strong move down. But that strong move is ended by one, you've got an engulfing candle here, okay, engulfs the previous candle. It then has an inside bar, then it has a pin bar, a rejection candle, all right, before price rallies all the way up. So as I said, identifying those candlestick patterns is useful, but when you can start to build a picture where you get 1, 2, 3 of them coming together, that can be very, very useful for us. As I said, they never happen as often as we would like, all right? They never happen as often as we would like, but if we can have the cognitive recognition ability to see them when they do occur, well then, that can be just a very nice little addition to your, let's say, your trading setup, to your trading armory. Think of it as you having, 3, 4, 5, 6 different setups, of which combining price action setups might be 1 or 2 of those, okay, two of those particular ones, because as you start to work with your favored markets and start to understand what you're looking to trade, well, that in itself helps enormously, okay, in terms of recognizing great setups for yourself. So for the purposes of today, what I'm going to talk a little bit about is, in terms of combining price action setups, is I'm going to talk about how sometimes they will appear as a one candle, okay, a standard setup, one candle, as in the reversal has happened within one candle, but then we might also have a 2 candle setup, or even a 3, or maybe even a 3 plus 4, 5 candle setup. That's what it is. That's when we start to see these combinations occur. And that's when we start to get interested. That's when we start to, really think of these as very powerful price action setups. As I said, they never happen as often as we want, but when we see them and we can recognize them, we want to be all across them as much as we possibly can. So let's have a little look at a few examples. And then if there's some time at the end, what we'll do is I'll try and switch across to the live charts so we can actually have a little look at, what's going on in the market at the moment. So a 1 candle combo, all right? This is where you might have multiple triggers all in one candle. It could be where you might see that there is a pin bar that also is an engulfing candle that is also a key reversal candle. It's very simple and powerful setup. Once again, never happens as much as you want it to, all right? You never, in terms of, they don't happen every single day of the week, but when they do, well, then they are very well worth sort of being aware of, okay? So, here's an example here. This is the DAX, okay? This is the DAX, the German index. It's been in an uptrend there, okay? It had literally it hit a bit of a ceiling, price falls back. Remember what I was saying is, a candlestick candle needs to basically be able to have it needs to be a little trend to reverse. And what we had here was we had a very big, strong candle here, okay? Big, strong candle. It's a variation of a pin bar. It's also an engulfing candle, and it is also a key reversal candle. So just in one candle, you've got 3 different types of combinations there. So when you see that in itself can be a very strong signal. And as you can see for yourself on the weekly chart there, price ran on and price accelerated away for the rest of the year in the DAX for that, okay? So as I said, they never happen as often as you want, ladies and gentlemen. I have to tell you that. but it's worth knowing when you see these, all right, remember, and this also happened at, this happened at the 50 period moving average, which we can see is support, all right? We can see it's dynamic support and an uptrend, bosh, away we went, okay? And then, even the classical, the kind of, let's say, oops, let's just clear this thing, even let's say the very classical sort of technical analysts will also be looking at that. Well, that's, an ascending triangle as well. So, for those of you who like to study your classical technical analysis patterns, but the important thing for us for today is, you had multiple setups in one candle, right? And when you can see that, well, that in itself is, is a real bonus, is a real benefit to you, really useful. As I said, doesn't happen as often as we'd like it to, okay? But when it does, bang, you want to be all across that, ladies and gentlemen. So that was a one candle combo. Sometimes these combos will appear as a two candle combo, all right? A two candle combo. And not unsurprisingly, as the name implies, is basically you've got two candles combining together to provide a trigger. All right. So a very popular one is a pin bar and an inside bar candle combination. Sometimes you get the inside bar first and then the pin bar. Sometimes you get the pin bar and then the inside bar. The important thing is that you're basically getting a two candle combo, and that what will happen is you're going to get a reversal. The right reversal is going to occur. And in this particular case here, I don't really even know, what instrument this is or what time frame. Absolutely fine, ladies and gentlemen, okay, because actually these will occur across all time frames and all instruments. And once you can start to recognize them, that is what we want to see. That is what we're looking to achieve, because once you recognize it once, you'll be able to see it whenever you see charts again in the future, and that can be helpful. And in this particular case, there was a drawn on here, there's a drawn on level of resistance. Price has been in a trend, hasn't it? Remember what I was saying, candlestick patterns, they need to have something to reverse. What actually happened is, we had an inside bar followed by a pin bar, right? An inside bar followed by a pin bar, two candle combination. Remember, the inside bar is the rest, we're going at surge, rest, and then surge again. What we had here, some people might call this a fake out, okay, a fake breakout in the rejection candle, but it's done that. And then what we can see is that price basically made a very strong move down to the downside from there. So price has been in a little uptrend, it ran up to a level of resistance, put in a two candle combo, in this case an inside bar followed by a pin bar. Once that happened, bosh, price rolled over, it fell away, and it fell away strongly back to the next level of support, and actually much further. So as I said, when we start to see these and you start to recognize these at particular levels and places on your charts, that can become very useful for you, ladies and gentlemen. And then, not unsurprisingly, you can have a three candle combo, which might actually even be more than three candles somewhere. But this is where you have three and more candles combining with you to provide a trigger. It could also be part of a bigger chart pattern. That is something that is worth recognizing, okay? Whether it's a continuation pattern, like we saw a ascending triangle there, or a flag pattern, or maybe it's a reversal pattern, like a double bottom, okay, triple bottom, maybe, a head and shoulders pattern. They don't happen often, but they are powerful when they occur. And, this is one here in terms of, here you have the price has been moving down quite strongly, okay? Here you go, you've got the first candle. That is an engulfing candle, isn't it? It's an engulfing candle there, followed by an inside bar, okay? So there's the second candle, followed by here, a rejection candle, okay? A pin bar. And that is a three candle combo. And it also just so happens to be, and excuse my drawing, it also just happens to be a double bottom, okay, which is a reversal pattern. And we can see that basically price takes off there, doesn't it? It blows out and then continues on. So, as I said, three candles don't happen as often as we'd like. But, once you're able to position to recognize them, when you see them in the chart, okay, you'll be able to trade it. And once again, I don't know, I can't remember what instrument that was or what time frame. It doesn't matter. Once you can recognize it, you can see it and trade it across all time frames and all instruments. That's what I want you to be able to do, to get a level of ability there. You can see what's going on, recognize it, and then trade what you see. Okay, trade what you see, whether it be a one candle combo, a two candle combo, three candle combo, even more maybe sometimes. But once you be able to see that, well, then you should be able to trade it anywhere you see it. So, I just put in a couple of simple examples here. Okay, so this is a gold on the weekly chart. I trade on a lot of the higher time frames, okay, for my, as I said, for my swing trading, and then, shorter time frames here. But, just effectively looking at, here we go in gold, $1,400, big round number, price basically comes up to it. And it puts in, just a simple, candle pattern, simple candlestick that it needs to reverse, does that, and then we can see it works its way all the way down. Okay, all the way down until it hits another big round number here at 1200. Big round number at 1200. What does it do? It comes down to that level. What do we get? We get a 2-candle combo there. There's an inside bar followed by a pin bar, which is also an engulfing candle, which is also a key reversal candle. Remember, a key reversal candle price, in this case, will push to a new low, but it closes higher than the high of the previous candle. Okay, it's showing a complete change in the market psychology. And what do we see? That price basically runs its way up. And what ends it? Well, as it gets towards that 1400 level again, then it basically puts in a bearish engulfing candle, isn't it? Okay, bearish engulfing candle before price sort of drifts away down. And then what we have here is, you've got a double there. Okay, you've got a double couple of pin bars there. Okay, which are sat there at that 1300 level. And I think basically what price went, if I remember right, the price went back up to the 1400 level from there, right? So I'm just throwing in. I've got a few slides here which have got different examples of different time frames, over different time windows, just different instruments, just to give you an indication. As I said, once you start to be able to recognize these, well, then you'll see them everywhere. I mean, that becomes really helpful, really useful to you, as a trading idea you can take away and utilize yourself. Here was the here's the sort of the Dow. We had. Gosh, this was the weekly chart on the Dow. We started by a nice little move up, followed by, what did we get? We got an inside bar followed by a pin bar. So there's there's a 2-candle combo there before price pushed its way all the way down. Price basically came back up to the area. Okay, and this wasn't a candle combo, but what we had there was a one bar candle there that was effectively, it was an inside bar that was also a pin bar. Price dropped down, and then we had one candle here. Okay, that's a pin bar. Then this candle is an inside bar, isn't it? But it's also a rejection candle. This candle here, it's still an inside bar, followed by, what do we get? Well, we get an engulfing candle there. Okay, it closed higher than that. It was higher than that. We had an engulfing candle there. So that's it's not a pretty sign, okay, but it's a double bottom there. Okay, it's not particularly pretty, but it's it's a combination, all right, of price action setup before price basically made its really long, big bold move for the rest of the year. So sometimes it's not always pretty. That's why just try to show different examples across different time frames, just to be able to give you an indication of what you're looking for and how you can utilize it in itself. This is euro against the sterling once again on the weekly chart here. And what we had here, this was as part of the going through kind of a lot of the Brexit sort of shenanigans, shall we say. Up here, okay, what have we got? Big round number there, okay, 90, all right, 90, you've got the 9 treble zeros. But what actually happened is we can see the first time price came up here, the price actually sort of printed an engulfing candle followed by a rejection candle before price dropped its way down. And then basically price came back up to it, and what did we get? We got a pin bar there, rejection candle. We then got another couple of inside bar rejection candles, followed by a bearish engulfing candle, pin bar, key reversal candle. So you've got here, there's a combination there, there's combinations there, okay, of you've got basically pin bars, inside bars, engulfing candles, pin bars, key reversals, multiple price action there. If you were to draw that down, you'd probably see that as a double top there. As I said, they don't happen very often, but when they do, they are very much worth taking note of, ladies and gentlemen. There's an opportunity there for you, and you can see the price drops away there. Okay, drops away quite significantly there. In fact, there's almost like a 500 point drop there in euro sterling, which in euro sterling, that's a big move. As you can see, I've got quite a few of them here on the weekly chart. I like to, that's my kind of main chart to work on, because it allows me to sort of trade around my other activities, my other lifestyle, my commitments, etc. It means that you don't have to be sat there every moment of every day. You're able to do a bit of work at the weekend and identify these opportunities, okay, as they set up, and then set them and let them work their way out for you. Okay, that's one of the many reasons I particularly like utilizing the weekly chart. And even Bitcoin, okay, on the weekly chart here, okay. So this was a few years ago. All right, you can see back when Bitcoin was $1,000. Okay, there you go, ladies and gentlemen, back in the dark days, so to speak. But price run up here to what was a 3,000 level here. Okay, price, it comes back to here to the 20-period moving average. Remember, moving averages can be dynamic levels of support. And what we had was an engulfing candle here, followed by an inside bar that was also a pin bar. And that was just giving us an indication that, there was buying support there. It's taking a breather. We had a surge. Okay, the first candle is a surge. Second candle is the rest. We want the third candle, though. We want that surge again, which is what happens. Price comes back down again. It puts another inside bar in, and before it works its way up there. Okay, so as I said, just utilizing lots of different examples from lots of different time windows and time frames, just to give you an indication there. As I said, once you start to recognize and be able to see this, you will see that you will see it everywhere. Here's the Kiwi dollar against the Japanese yen on a 4-hour chart. We can see that price is in a nice uptrend. Okay, price is in a nice uptrend. We can see that price comes back to the 20-period moving average. It's not a terribly clear pin bar there, but what we have is an inside bar, okay, at the 20-period before price pushes up. Price comes back down. We get a 2-candle combo. We get a very small inside bar there, followed by a pin bar rejection candle, which is a fake out. Okay, fake to go low before it pulled up higher, and then price pulls its way up. When we come back down here, okay, we're at the 20, but this candle is it's a little bit of indecision. It's an inside bar, bit of indecision. Okay, we get a little bit of a pin bar, but price is going sideways. What we want is actually to see that price falls down to the 50-period moving average, puts in a 2-candle combo there. Okay, and there's a pin bar followed by an inside bar, and price pops up, and people might be a bit worried. Okay, they might have seen this candle getting a bit worried, but it's still with the particular trend. Okay, and as I said, price then goes sideways here for about 3-4 candles. Remember, ideally, what we want to do is we want to see candles that are reversing a little bit of a trend. Okay, that's just congestion before it goes, but that's the kind of move was back here. Okay, bouncing off the 50-period moving average. That's bouncing off, okay, a level of dynamic support in that particular case. On a bigger scale, all right, this is Kiwi against Japanese yen on effectively the weekly chart. And as we started the year, okay, price had rallied its way up, and it ran into the 200-period moving average. What we had was a little bit of an inside bar pin bar. That isn't, there's not really a trade situation in itself, not a terribly strong one. But when the next candle, the second candle combo is a rejection candle, which is also a bearish engulfing candle, which is also a bearish key reversal candle. Well, now we do have, now we have a trade set up, and we can see that even, just the first kind of impulse move there takes us a good while down from around about 78 to 75, a 300-point move there, okay, on the Kiwi against the Japanese yen. And as I said, they don't happen very often, but when they do, okay, you can start to sort of, see them, powerful setups, and you normally get a powerful move from that kind of combination. So it's worth adding this to your armory as a way and a means to trade yourself. So here you go. Here's some final points. Here's some homework for you. I always like to give you something to take away with. Go through your favorite charts and identify possible price action combos. How often did they occur? As I said, they won't happen as often as you like, but they are worth be keeping an eye on. Where did they occur? Did they occur at significant price levels, whether it be horizontal support resistance, whether it be a big round number or dynamic support resistance off a moving average? did it provide a good trading opportunity for you? So there's your homework. Take that away, you know, as you go for the rest of the week and the weekend, just take away, go through your favorite charts. You know, it is well worth doing the homework. So in conclusion, ladies and gentlemen, price action analysis is a way of analyzing markets using purely price action. We're looking for price action triggers at significant price levels, prices, or zones. And it allows us to build a simple price action trading plan. When we see price action combinations, that provides us with a strong signal. But as always, it's important to do our analysis and manage risk. Running out a little bit of time here, so we'll just have a quick look at one or two very quick looks on the live markets. As always, if you want to contact Admirals, you can go to the Admiral Markets website, or you can email them at global@admiralmarkets.com. As I said, we're running out a little bit of time, but I'm just going to go for a moment, just quickly to show maybe one example or so. So just bear with us a moment and we'll switch across to the Admirals chart platform just to have a look there. Okay, so just looking at this is the first chart. This is the first chart came up for me. Okay, so I'm just going to very quickly draw on what I see here. This level here, okay, has been 76.55. It's been a particularly high level of interest for us. Every time the first time price comes up here, it's basically battered down. Price comes back up to it again, and it's a very poor PIMBA. It's not really a very good PIMBA, but then what we get is we get one, two, couple of inside bars there. Okay, there's inside bars occurring there. The price, remember what it is, inside bars is the rest before the surge. We know the last time that price came in, it got battered down, and what happens is it gets knocked down again. But then actually when price drops here, okay, price drops strongly, puts in an inside bar there, which isn't really of that much of interest to us at the time. But then what we see is it basically comes down, puts in, you know, a double bottom pattern before it moves its way up there. Okay. So let's just have a quick look at what's here. Okay, yeah, so this is pound against US dollar. What are we, 4-hour chart here, okay, 4-hour chart. So price has been in an uptrend, okay? Price has moved its way up. Price has pulled away from the 20-period moving average here, okay? You can see price looks as if it's going vertical. And then what it does is, what does it do? It puts in not 1, 2, 3, it puts in 3 inside bars within the range of this candle. There's 3, there's a combination there, okay, of 3 inside bars. That in itself is telling we've got, you know, we've had, here we go, clear this. We've had the surge, now we have the rest, now we're waiting for the next surge. That's what we're looking for, that's what occurs, and price retraces, okay, mean reverts back to the 50-period moving average from there. So there you go, ladies and gentlemen. Unfortunately, we've run out of time there. I wanted to show you a few more examples just looking at live markets. But as I said, there's homework there for you to take away. Just go away, look through your favorite charts, see with a particular price action combo setup where you've got 1 candle, 2, 3, maybe more that built there that gave you an opportunity, all right, to get into a good trade. As always, okay, I hope you found that useful. Just remember that at the end of this session, there will also be just a quick little feedback form that will get sent. If you could take the 30 seconds to fill that out, we'd really appreciate that. Would help. Maybe you've got ideas what you'd like to see us cover in the future. As always, just to finish off, it really is for me to say, I wish you the very best of success in your own trading endeavors, ladies and gentlemen. And I look forward to speaking to you soon. Trade well, everybody. Cheers.